nice. Finally, I'm done with the review. Hello Naim, what's the matter?
Hello Fakri. I want to report to you that one of our major customer, Papa Mega Holdings, has just returned to us their shipment of goods delivered to them in the quarter 4 of the last financial year. So the total of sum is quite a lot. It's about 4.5 million.
Yeah Naim, 4.5 million? Is it right? That's going to bring down our sales performance. Okay, thanks for informing me. Next, I will need to inform the sales director.
Okay, I will make the adjustment required for your review. Oh, Fakri, what's the matter?
Okay, Kak, listen. Papa Mega Holding just returned a large amount of goods with 4.5 million.
Well, that I can explain. My staff had made a careless mistake. He shipped 50,000 units instead of 5,000.
We need to adjust the figure downwards by 4.5 million then.
Well, Fakri, can you wait till January before you put the sales adjustment instead of putting it through December? Because it was just a small mistake and everyone is looking towards their bonus for our good sales performance.
I'm afraid not, Kak. Not.
Come on, Fakri, please. You know how this adjustment will affect our sales performance and our bonus will be badly affected.
My bonus will be affected too, but the account should always be fair and true.
Okay, now you listen, Fakri. I have reprimanded all my staff and this matter is closed. Do not insist on adjusting those numbers and make everyone suffer for it. We can talk to the CEO by ourselves. Now go.
Okay, no problem. You selfish son of a...
What is the definition of fraud?
Definition of fraud. Fraud is the generic term and embraces all the multifarious means which human ingenuity can devise, which are resorted to by one individual to get an advantage over another by false representation. Second, no definite and invariable rule can be laid down as general proposition in defining fraud, as it include surprise, trickery, cunning and unfair ways by which another is cheated. The only boundaries defined are those which limit human knavery. Fraud also can be defined as an attempt by a corporation to deceive or mislead the users of published financial statement, especially investors and creditors, by preparing and disseminating materially misstated financial statement.
What is the elements or fraud?
Fraud is the deception that include the following elements, which means representation about material point, which is false and intentionally or recklessly so, which is believed and acted upon by the victim, and lastly to the victim's damage.
What is the example of fraud versus not fraud?
Example of the fraud is someone purposely enters incorrect numbers on a financial statement to trick investor But example for not a fraud, we firstly is someone mistakenly enters incorrect numbers in the financial statement, and the second one is an international error is none of fraud.
Management fraud or financial statement fraud.
Management fraud or financial statement fraud involve top management deceptive manipulation of financial statement.
Who commits fraud?
From the research shows that anyone can commit fraud.
What
Most
is
fraud
the three key elements?
perpetrators have profiles that look like those of honest people.
Assalamualaikum, my name is Hidayah. I'm going to explain one of the fraud triangle theory, which this theory is basically explain the main reason behind the occurrence of fraud. What I'm going to explain is about perceived pressure. What is perceived pressure? What is pressure? Pressure is the use of persuasion or intimidation to make someone do something. What is perceived pressure? Perceived pressure is a key element that drives people to commit fraud. In other words, perceived pressure is a person's perception of a motive that causes a person to do fraud. According to the past studies, pressure is a factor that drives someone to cheat, and also it could be in the form of economic demands or lifestyle. For example, pressure may come from family that unexpected need money to pay expensive medical bills, or maybe that individual have some large of debt that he need to pay urgently. If he not pay, he will be hunted by loan shark. And this individual maybe try to borrow from the bank, but they get turned down, and their family would not be able to help them, so they have some financial needs that they don't think that they can meet on their own. This kind of excessive pressure will drive people to commit fraud. Everyone that face pressure to do things that they would normally not do. Another example from perspective of debtors, the debtors would be pressured to commit financial fraud in order to gain more profit, might be due to the personal interest such as greed or personal debt, unexpected financial needs, or having a feeling of job dissatisfaction might be the pressure that caused them in committing fraud. In Malaysia, fraud by a company's director is punishable under the Penal Code, the Companies Act, and the Securities Commission Act. Under the Penal Code, fraud is defined as an act of deception with the intention of gaining an unlawful advantage. Penalties for fraud can include fines, imprisonment, or both. Under the Companies Act, the director can be held liable for fraud if they are found to have been negligent in their duties, or if they have personally benefit from the fraud. Under Section 447 of the Act states that any person who is found guilty of fraudulent misapplying or returning or becoming liable or accountable for any money or property of the company, or any money or property entrusted to him while he was an officer of the company, shall be punished with imprisonment for a term of up to 5 years or fine up to 5,000 or both. Under Section 420 of the Penal Code, criminalize cheating and fraudulent inducing a person to deliver any property and prescribe punishment of imprisonment up to 10 years and fine it. Unfortunately, this law did not 100% constrain the debtors in committing fraud, even though they know that if they commit fraud, they would be punished under this law due to the pressure that they have. For them to be able to commit fraud, they need an opportunities, which will be explained by my friends.
The second part in the fraud triangle is opportunity.
Who have the opportunity to do fraud?
People who do fraud had the opportunity to do so because there is a lack of controls that prevent and detect fraudulent behavior. Inability to judge quality of performance may also be one of the reasons. Managers also fail to discipline fraud perpetrators. Other than that, lack of access to information can enable the fraud to happen since they can manipulate the information. If the fraud is going to occur, there must be an opportunity for it to actually happen. For instance, if a company runs a no-cash store, there is no opportunity for cash to be stolen because if there is no cash on premise, so there will be no opportunity for cash to be stolen from the company, at least at the retail spot. Because there is no cash, the ability in fraud cannot occur. The easiest one or the easiest element to be taken away from the fraud triangle or from a business standpoint is the opportunity. Companies can also do things about rationalization. However, rationalization cannot always be brought down to zero, but opportunity can. For instance, if you do not want cash to be stolen, you don't have to collect any cash. By doing that, you have taken the opportunity ability to fraud, so there is no chance for someone to steal the cash if the company doesn't accept cash as a valid payment.
What is a rationalization?
Okay, now I want to talk about rationalization. Rationalization is the reorganization of the company on the order to increase its operating efficiency. This sort of reorganization may lead to the expansion or reduction in company size, a change of policy or alternation of strategy, penetration to a particular product offer. Similar to a reorganization, a rationalization is more widespread, encompassing strategy as well as much structural change. Rationalization is necessary for a company to increase revenue, decrease costs, and improve its bottom line. Rationalization may also refer to the process of becoming calculable. For example, the introduction of the certain financial model of financial technologies, rationalize market, and makes them more efficient. The introduction of the Black-Scholes model of the option pricing, for instance, helped to rationalize the option market in Chicago in the late 1970s.
How to understand rationalization in the business world?
Understanding of the rationalization. In the business world, rationalization is the process that most organizations consider. That's because it's aimed to improving efficiency, getting rid of the waste, standardizing process, and ultimately boosting the bottom line. Depending on the company and strategy, rationalization can result in the expansion or reduction in the size of the firm. This can also lead to structural change. Especially the process of rationalization may involve corporate action, including sales or closure of underperforming business segment. The expansion of the outperforming segment, a complete restructuring of the company's financial structure, and a streamlining or modernizing of the maturing of the operation.
What is the pros of rationalization?
Pros of the rationalization. Firstly, help the company become the more efficient and boost productivity. Allow management to implement modernizing technology and system, lower market volatility, can provide the workforce for the better working condition and higher pay, translate into the higher standard of living in society, and lastly can lead to the lower price and better product for the consumer.
What is the cons of rationalization?
Cons of the rationalization is emphasize the efficiency at the expense of human capital, often involve large layout, can lead to a significantly increased work out for the worker that remain, loss of initiative from worker due to the mechanizing of the process, costly and require consistency monitoring, and lastly no guarantee of improved return.
What is the need for Rationalization.
Why we need the rationalization? There are several reasons that particular organization might need to go through the process of rationalization that include need to firstly reduce costs, maximize profit, conserve resource, unlock shareholder value, improve transparency and government, simplify the business model, eliminate the unnecessary product and either capacity, update all machinery and other business process. And lastly, the fast track, the process of organization is especially common during recession and after corporate actions such as a merger, acquisition, and new CEO hire. That's all for me.
What is the definition of earnings management?
Earning management occurs when managers use judgment in financial reporting and in structuring transactions to alter financial reports to either mislead some stakeholder about the underlying economic performance of the company or to influence contractual outcomes that depend on reported accounting numbers.
How many types of earnings management?
There are two types of earning management, which is income increasing earnings management and income decreasing earning management.
What is the motives of income increasing earnings management?
The motives of income increasing earning management is to avoid reporting loss, to meet or beat the earning forecast by the financial analyst, to increase BOD potential in receiving high bonus or compensation, to get the contract from the government or other firms, and to increase the profit so it will eventually increase the share price. If the manager hold the firm's share, increase in the share price will also increase their own wealth. High share price increase the reputation of the firms as well as the shareholder wealth.
What is the motives of income decrease earnings management?
The motives of earning management, which is income decreasing, to avoid high tax and to avoid paying high salary or bonus to the employees.
What is the example of earning management?
One method of manipulation when managing earnings is to change to an accounting policy that generates higher earnings in the short term. For example, assume a furniture retailer use the last in first out, which is LIFO method to account for the cost of inventory items sold. Under LIFO, the newest unit purchased are considered to be sold first. Since inventory costs typically increase over time, the newer units are more expensive and this creates a higher cost of sales and a lower profit.
How the managers manage earnings?
The manager can choose from a menu of treatment that are acceptable under GAAP, such as LIFO to FIFO, the full cost method versus successful effort mentioned in oil and gas industry, depreciation method from straight line method to reducing balance method, revenue recognition policy, which is manipulate the difference between revenue and cash flow.
Conclusion.
As we all know, fraud is the manipulation of financial accounting beyond the accounting standard boundaries, while earning management is the manipulation of accounting rules within accounting standard boundaries. So we can conclude that both fraud and earning management have bad implication to the firms and to stakeholders. The large firm also can easily collapse due to the fraud. That's all from us. Thank you.